Most people think a raise is the only way a paycheck feels bigger, but a paycheck can feel bigger without income changing if 3 leaks shrink. By the end of this video, you'll be able to look at your own month and tell which of 3 levers will free up the most cash, and how to measure it on your next statement. This is educational information, not financial advice. Picture someone who gets paid every other Friday. Their pay is steady, but the month feels tighter than it did a year ago. Rent is due on the 1st, a car payment hits mid-month, and the credit card bill lands right when groceries are highest. Let's keep one simple anchor month. Say, take-home pay is about $3,800 a month. Rent is $1,650. Car and insurance together are $520s. Utilities and internet are $20. Groceries are $520s. That leaves roughly $890 for everything else. That tight feeling usually comes from 3 forces: fixed outflows that quietly climbed, timing, when bills land before money lands, and interest leakage, where debt charges eat your breathing room. Lever 1 is reducing high-friction outflows. These are charges that behave like a tax on your life because they hit no matter what happens this week. 2 common sources show up fast: recurring charges like subscriptions and app memberships, and sticky bills that auto-increase over time, like phone plans, internet, and some insurance renewals. The mechanism is simple. If a bill is automatic and small, your brain stops noticing it, but your bank account never forgets. Here's a clean way to measure this lever. Look at the last 30 days of transactions and add up recurring charges under $25. If you find 8 charges averaging $12, that's about $96 a month. That's predictable money, which matters for stability. A helpful decision rule is to separate daily value from background value. If you'd notice it missing within a week, it's daily value. If you'd only notice when the charge hits, it's background value. Background value is usually where the easiest savings live, because the downside is smaller. Another quick test is annualizing. A $12 charge feels small until you hear it as about $144 a year. That doesn't mean it's automatically bad. It just makes the trade-off visible. For budgeting and saving systems, lowering fixed monthly burn makes the whole plan easier. For everyday prices, it gives you cushion when groceries or utilities jump. And for debt and interest, it can be the difference between carrying a balance and clearing it. So, what changes for our anchor person? If they find $100 of recurring spending and remove half, that's $50. On paper, $50 looks small. In practice, $50 can cover a timing gap and prevent a fee once, which often costs more than $50. That leads into lever 2, timing. This doesn't show up as overspending, it shows up as stress. Timing is a cash flow problem. You can be on budget and still get squeezed if the due dates stack early in the month. Here's a simple example. Rent is due on the 1st and you get paid on the 2nd. If that shortfall triggers a $35 overdraft fee, that's not a budgeting issue. That's a calendar issue. Some bills let you pick a different due date. One option is choosing a due date a few days after payday. The upside is fewer squeezes. The downside is it can take a billing cycle or 2 to fully shift. Another option is a tiny bill buffer inside checking. This isn't a full emergency fund. It's a small amount that exists only to smooth timing. If your typical timing gap is $200, a $200 buffer can stop a fee cascade. The downside is you have to build it once. So what changes for our anchor person? If their bills cluster in week 1, they may feel broke in week 1 and fine in week 3. A calendar fix can make the same income feel calmer. Now, lever 3 is interest leakage. This is when debt costs drain cash, even if you're paying every month. Use one clean example. Say there's a $3,000 credit card balance. If the annual percentage rate is about 24%, that's roughly 2% a month. 2% of $3,000 is about $60. So, before your payment touches the balance, about $60 is getting added in interest each month. If you pay $90, the balance only drops around $30. That's why people feel stuck. Their payment is real, but most of it is covering the cost of time. Here's the connection. If you free up $50 from recurring charges and you stop one $35 overdraft, that's $85. In the example month, that $85 can more than double how much of the payment goes to the balance, not interest. There are a few education-only options people use to reduce interest leakage. One is paying down the highest rate balance first. Another is using a lower rate balance transfer offer for a period, with fees and timing trade-offs. A third is replacing revolving balances with a fixed payment loan if terms and approval make sense. Now, how do you pick the best lever without guessing? Use a simple rule based on your timeline. If you need relief this month, timing and friction usually win. They move fast and you can see results on the next bank statement. If you can wait 2 to 3 months, interest leakage often becomes the bigger lever. That's because interest savings compound, but it takes time to show. If you're not sure, run this quick 3-number check. First, add up recurring charges you could live without. Second, estimate what timing has cost you in fees or forced credit card carries. Third, look at the interest charge line on your latest credit card statement. Whichever number is largest is usually the lever with the biggest payoff for your life right now. Now, put those levers into a clean order so you don't try to fix everything at once. If cash flow is the main stress, start with timing. That's the lever that stops the fee cascade. The upside is speed. The downside is it won't lower your cost of living by itself. If the month is mostly fine, but it feels too tight, start with friction. This is where the invisible charges live. The upside is you get a permanent reduction in fixed spend. The downside is each cut is small, so you need a few of them. If you're paying interest every month, make interest leakage the long game. The upside is that every dollar you keep is a dollar you can use again next month. The downside is you only feel it after a few statements. Go back to our anchor person. They found $50 a month of background charges they don't miss. They also shifted one due date so the credit card bill lands after payday. That removes one overdraft and one late fee in a bad month. Now the credit card payment has a better chance of touching the balance. Here's a simple way to measure whether your paycheck is feeling bigger in real life. Pick one metric for each lever and track it for the next 30 days. For friction, track fixed recurring spend. That's the total of subscriptions, app plans, and predictable auto bills that aren't rent or utilities. If that number is down even $40, your month has more oxygen. For timing, track fees, and bridge spending. Fees are overdrafts, late fees, and rush charges. Bridge spending is when you use a credit card for basics because the bill came early. If those drop, your stress drops, even if the income doesn't change. For interest leakage, track interest charged. Most credit card statements show it as a separate line. If the interest line is trending down, your money is leaking less. A common misread is thinking the best lever is the biggest one on paper. In tight months, the best lever is often the one that prevents a spiral. A $35 fee is not just $35. It can trigger more fees, more interest, and one missed autopay. That's why timing is so powerful when money is close. Now, let's do the 2-minute checklist. This is not about being perfect. It's about finding the one place you can get lift. First, open your last full month of bank activity. Search for monthly, subscription, and recurring. Write down every charge that repeats. Second, open your credit card statement. Find the interest charge line. Also find the minimum payment and the statement balance. That tells you whether your payment is buying time or buying progress. Third, look at your fees. In your bank activity, search for overdraft, returned, and late. Add them up for the last 90 days and divide by 3. That gives you a monthly average of what timing is costing you. Fourth, look at due dates. List your rent, car, and credit card due date on one page. Then write your paydays under them. If the biggest bills hit before pay, that's your problem, even if your budget is fine. Fifth, pick one small change for the next cycle. If timing is the issue, one option some people consider is moving one due date or building a small checking buffer. If friction is the issue, one option is canceling one background subscription and waiting 30 days to see if you miss it. If interest is the issue, one option is focusing extra dollars on the highest rate balance so less goes to interest. Back to the promise. You should now be able to look at your month and name the lever that frees the most cash and how you'll measure it. That's how a paycheck feels bigger without a raise. Not through hacks, through fewer leaks, better timing, and less interest drag. And if you're in a tight season, start with stability. The goal is not to squeeze joy, it's to stop the month from wobbling. If this helped, subscribe to the Wealth Blueprint for more clear money breakdowns. Leave a comment below with the next topic you want covered.